let's move on. We're going to talk about the home equity loan. This is a little bit more detail-oriented today, guys. We're going to talk about home equity loans for those of you who are homeowners already, and you may have heard what a home equity line of credit is, or the acronym HELOC, home equity loan, home equity line of credit. This is from CNBC. Now, this is a little bit more of an evergreen piece from CNBC, kind of talked about the generalities of HELOC. So I want to go over some of these things, but I also want you guys to say from the front lines, how do you see people using this? What are they doing in San Diego? What kind of scenarios should people watching this go, oh, that's me. I heard my scenario in what they just said.
We were talking about earlier about the 40s, how everybody's blueprints change. I like to use blueprint only because, you know, my mom taught me a certain blueprint of what I needed to do, how I do debt. My mom told me, don't get in debt. If you can't afford it, don't buy it, right? And then as you start seeing, studying more rich people, they understand how to generate proper debt, right? There's such a thing as good debt, you know? And so those are the things that my main focus is on now. So my blueprint's changing. I'm hoping to change that blueprint for my kids so they have this different, you know, view of things and just want to take a little more risk if they need to. But anyway, when we were doing home equity lines of credit back in the day, and you remember this, these lines of credit were not being utilized in the way they were meant to be utilized. Right? We were using them to keep up with the Joneses. If he has that Hummer, how do I get that thing too?
Yeah,
right?
It was the Hummer equity line of credit.
Very. Exactly. I did it in a reverse way. I was acquiring more properties with it. Hey, I didn't have to put 100%, and then you get to a point where 100% doesn't work for you. You have to put money down. And so at that point in time, that's when I started buying more with using the line of credit here, buying that property. So it just depends how you utilize it. But back in that time, Brian, that's how it was for most. How do we purchase things and just spend it on things that create no value for you?
Wants
they just become
versus needs.
There you go. Exactly. So nowadays, I think with all the information with social media, they're getting very creative in a sense. Let me teach you how you can utilize this so you can generate more wealth and create another financial vehicle to help support your financial income, whether it's creating an ADU, investing in other properties, and investing in another business. These things are happening.
Yeah. And I mean, there's still a lot of that going on probably, like not say, but a lot of the financial habits have changed. And I feel like some of the clients that I'm speaking to right now, last year when they pulled the HELOC, they weren't in so much debt, but they're like, these credit cards are rising and, you know, a whole bunch of and interest. But my mortgage has stayed the same. How can I utilize that, have a clean slate, remove money over here and put it back over here? So, you know, I think a leverage point is utilizing it to wipe out your debt, but at the same time using it as a pedestal to go, you know, jump onto something else. Now, one of the things that I think people need to understand is, you know, the product and how it works, and also their situation, because, you know, taking that money sometimes isn't always the best route, because then how are you going to pay it back if you don't have an exit strategy? So I think really identifying, you know, your situation and knowing if you can pay it back down the line, whether it's, you know, through adding value to the property or, you know, you're going to consolidate your debt and it makes financial sense. I think that's the smartest way to use it, but not, you know, if you have the money, don't get it more money if you don't need it.
Yeah. So the first thing I think to know here is that, you know, when you're looking at home equity line of credit, you are tapping into your home's equity. Okay.
Correct.
It's in the name. It's home equity line of credit. So this is something that you have to be wise to consider to make sure that you are putting yourself in a position that is advantageous versus at a further disadvantage just because you qualify to do it. So there should be a plan going into it and a plan to get out of it, or a plan to be smart and wise about how to use the funds either upfront or along the way or over the course of time. There are situations I've heard you guys talk about and people talked about me in the past about, which is they wanted it for a rainy day. Now, that is also okay. However, if you do pull a rainy day home equity line of credit and you do not use it, the bank can also pull that back and they can reduce the total limit or just ask to close it out because you're not using it. Now, that is maybe less rare than normal, but I just want everyone to know that that is a possibility as well. If you take one out for a rainy day and you don't use it, well, if you don't use it, you lose it in some cases. But if you're going to use it, it could be for a lot of different reasons, guys. We see debt consolidation. We see people doing it can do a garage conversion, to have a rental unit on their property, to build an ADU, add a second story, extend a wall. Like, there's all sorts of home things that the house can do the heavy lifting for.
So use it before you lose it, but don't abuse it.
Okay.
I like that.
Brian's rap channel coming March 2024.
Well, here's the
One
thing.
song.
Here's the other thing to remember. There's two types of equity lines of credit. There's a HELOC, home equity line of credit, and a HE loan. It's just a home equity loan. The home equity loan, the way it is once you take that money out, your property has to have X amount of value, right? So let's just say $100,000, just to keep it simple. And you owe right now, hey, the value of the home is $100,000. You owe $50,000. You could go up to 80%, sometimes 85, 90% loan to value, depending on your income, and your pretty much what your income is, what assets you have, et cetera, where the bank's going to take more of a heavier risk, then they'll let you borrow more from it. But let's just say you get to 85%, loan to value. Those funds immediately on a HE loan, they'll deposit them to your account.
Yeah.
So you start making payments the following month.
Yeah.
Yeah,
it's already.
Exactly. It's already there. Whereas a HELOC, the home equity line of credit, works more like a credit card.
Yeah.
You have it there, and that's the one that you can use for a rainy day.
Yeah.
But usually that comes at a higher rate.
Yeah. Yep.
You just got to see what line of credit is going to fit best for you.
Yeah.
100%.
The thing that I want to make sure we also talk about is that, the article references that people sometimes use it for repairs or renovations or maybe even upgrades, and that in some cases that can positively affect your equity. But I want to caution everybody, just because the article says that, you have to take into consideration some other things. So listen up. Number one, just because you change your faucets from old to new doesn't make your house worth $100,000 more. Number one. Item number two, just because you change your flooring does not mean that your house is $100,000 worth more. Not everything on HGTV is as it seems. So the truth is that if you add square footage, if you're adding to the footprint of your property, and it can be compared to other like-sized properties with the same amenities, you stand a far better chance of that increase of equity. So be careful. Just because you build a $50,000 pool in the back, the bill's gonna be $50,000 to build a pool. That doesn't mean your property's going up $50,000 right away. So be very careful with that, because a lot of these articles I've seen, including this one, say that, this is a way you can increase how much your property's worth. But that has a lot to do with if you add on, not just make it modernized and updated.
I mean, that's a great point. It really is. You're not going to get dollar for dollar, right?
Nope.
If you have that $100,000 pool, I've seen a $100,000 pool just get, when they do an appraisal, $25,000.
25, 30.
30,000.
Yeah.
But wait a minute, I spent 150,000, right? It's like,
good for you.
Or they buy this brand new house in this lot, right? And it's got X amount of views, so they send it with a higher premium.
Right.
And the new bill, usually 40, 50,000, but when the appraisal, it's a $10,000 view.
Yeah.
So it's crazy. So it's not dollar for dollar. So
I
that's
think
a great
you got to
point.
look at price per square foot. You got to see what is it you're looking to change, and then is there an equivalent value increase based on the comparables, like what you will have at the finish of your upgrades or modernization or whatever it might be. Modernization in some cases brings it to what the value should be, not what it's going to be.
That's what I was going to say, because what if there's a block where houses are for the most part all got flipped and they look nice, and then somebody decides to join the crew, and then heck yeah. You're just going right at market, buddy.
I mean, sometimes it's good to just bring it up a little bit. A little facelift. Not bad, just to sell the property much faster.
Well, sure.
And those things do.
Because here's the other side of it. You put your house on the market now, and it's 30 years out of date. Someone's going to give you a 30 years out of date price. They're going to go, hey, give me a 10% off on that deal, or 15. I'm not going to pay you full price on that.
And
I don't know, Andy. You're in California.
No, hold on. I know here.
I know, it's crazy.
That's what we're talking about, because someone will still buy that at market value or outbid the next guy and do the upgrades on their own. My point is, though, when the article's saying use a home equity line of credit to tap into your equity, do upgrades, and then that's going to make your house worth more, that's not always the case.
Correct.
There's some definite things you need
not
to be more
dollar for
considerate
dollar, that's for sure.
Yeah. So
that's a great point.
If you are going to get a home equity line of credit, you need to make sure you have sufficient home equity. You need to make sure your credit is in line. You have to have proof of income. You have to have a low debt income ratio.
Yeah.
There's got to be insurance. Like there's a lot of things that are technical, but they can be easily overcome by just having a little of a checklist, a conversation with one of the guys, and then figure out what you got to do.
And
go ahead. Well, here's another misconception on the lines of credit, right? When you do a mortgage, when you're getting a purchase or refinance to do your major mortgage, you got to do your pay stubs, your W-2s, all that stuff. But people think when you do a home equity line of credit, I don't need to do those things.
Yeah.
No, same sequence. Yep. It's the same information that's going to need it. Why? Because in lending, we need to support that you're able and capable of making those payments.
Yeah, the full payment.
That's the exit strategy, that you currently have a job, that you currently have the income, that you're able to make these payments for your first mortgage.
Yep.
and the second.
Right.
and the additional money you're asking for. Yeah.
That's it.
What I was going to say is that last year, on the flip side, we had a client that didn't get approved for a home equity line of credit, and it was because she had a lot of high credit card debt, pushing the 50% limit. And one of the things that, I'll let people know is that, don't wait till you're at that point. If you're able to seek help or seek that solution before you get into that problem, definitely, search sooner, because once you're down that road and you're too far in, it's going to be very difficult. And for this case, our client wasn't able to get approved because she was already maxed out. And, and the bank knows at that moment you're utilizing that to basically bring that down.
Yeah.
And that to them looks like a risk.
So I want everyone that's watching this to know, like when you come and talk to Brian, talk to Memo about this, they're not hard pressed to sell you a loan, guys. It's about figuring out what is you're trying to accomplish, and is that even the best way to do it?
Yeah.
Sometimes that's not even the best way to do it, and sometimes there's no other way to do it, and the house has to pull some of its own weight, and you're going to have to use that equity. But that's what these guys are for, and that's what they'll help you.
Just like anything else in life, there's pros and cons.
Yeah.
Yep.
100%.
And the only way to get out of something is you got to take the leap of faith and risk.
Yeah.
Sacrifices.
Yep.
That's right.